welcome to Live Wire Markets. My name is Chris Conway. Today I am sitting down with the Australian Equities panel from Yarra Capital Management. We'll be discussing the recently completed reporting season and perhaps more importantly, the biggest opportunities over the coming months and years. To do that, I am joined by Marcus Ryan, Michael Steele and Joel Fleming. Gents, it's nice to see you again.
Good to be here, Chris.
Fantastic. Let's dive in. We'll cover off on reporting season first. We'll spend a bit of time talking about it. Marcus, I'll come to you first. How would you characterise the season that we just had?
Thanks, Chris. It was a mixed reporting season overall for ASX 200 companies with generally cautious outlook statements. Mixed was really demonstrated by quite an even number of result beats and misses for the reporting period we've just been through. Earnings declined across the market by around 4%, and that was broadly in line with the market expectation. Interestingly, sitting behind that, resources and banks were a little bit better, while industrials and REITs were a little bit softer. The cautious outlook was really demonstrated by the guidance statements, where we actually saw 4 in 10 companies that guided below a consensus expectation, whereas only 1 in 10 who guided were actually above the consensus expectation. So with that as the context, we felt overall it was a pretty credible reporting season and a credible outcome with the market grinding about 0.5% higher.
Michael, in terms of small caps, how did you see the season?
In terms of the small caps reporting season, the results for the last 12 months are actually negative, but the outlook was positive. In terms of the last 12 months of results, we saw a continuation of the macroeconomic headwinds from the prior year. So we saw earnings decline because of pressure on volumes, pressure on margins, and also higher interest costs. However, more importantly, looking forward, the outlook is positive. We expect to see accelerating earnings growth over the next 2 years to over 10% per annum, supporting a positive outlook for small companies.
Let's talk major themes, gents. Joel, I'll come to you. What was one of the major themes of the season?
Well, look, a couple of themes that really stood out to me, Chris. Volatility. So on result day, the swings in share prices were extreme. Says to us that people are incredibly short-term focused here, and that's creating a lot of opportunities for us longer-term investors to look through some of that noise. The follow-through of that was some of these fallen angels that have kind of re-emerged. So think Nuix, Bravura, Zip, companies like this, whether it be a change in management team, change in market conditions, you can't ever discount anything. These have been some of the stocks that have performed the best through this reporting season. And I guess the third thing is we felt it was much more of a normalised reporting season. So there's no big accounting changes running through. We don't have all these COVID issues washing around. And even though the economic backdrop is a little bit tougher than it has been, it has meant that you can actually see those underlying performance issues of those companies and really start to see which companies are doing well in those industries and who's executing well as a management team.
Michael, what was one of the other big themes from the season?
Another notable theme from reporting season was cost inflation moderating, and we believe that'll support margin expansion into financial year 2025. So there's a lot less references on conference calls around cost pressures to businesses, and that's being supported by reducing commodity prices, so input commodity prices such as oil, steel's coming down, soft commodity prices are lower, and the other major factor is moderating wage inflation, and the lead indicators support that wage inflation continuing to moderate, which is a major benefit to margins going forward.
Marcus, big question for you. What was the highlight of the season?
Look, a key highlight for us was really around the strength of some of the results of these quality franchises in the market and really across a range of industries as well, and companies that are navigating really crosswinds from a macro perspective. So we could call out within consumer electronics, JB Hi-Fi, within healthcare, ResMed, and in terms of online classified car sales in that space as well. And what we're really seeing with these quality franchises is evidence through the results of ongoing share growth, of product leadership, of really solid free cash flow and strong incremental margins. And interesting, this cohort of stocks actually grew by over 10% through the month of August alone.
Michael, the other side of that coin, what was the low light of the season?
A low light of reporting season was clearly the resources sector. We saw continued material negative earnings revisions. Those earnings downgrades to resources were driven by lower commodity prices, so we saw iron ore prices coming down and lithium prices have dropped dramatically. And the other factor, in particular within the small companies market, is a continuation of production downgrades from the more marginal producers, and that's been an earnings headwind we've seen for at least the last 3 reporting seasons.
All right, gents, now that we've covered reporting season, I really want to focus on the key opportunities over the next 12 months. Marcus, I'll come to you first, talking about large caps, quality income. It's so important for Australian investors. Where do you expect it to come from over the next year?
Yeah, from a quality income perspective, we're seeing real opportunity in a number of the quality real asset names out there at the moment, skewed more so to infrastructure. In particular, Transurban, generating dividend yield around 4.5%, growth in that dividend, importantly, we think of 5 to 6% over time, and really underpinned by the cash flows from those long concessions. APA, so gas infrastructure, renewable player, dividend yield in excess of 7%. We see it'll be a beneficiary through the energy transition. And finally, from a quality REIT perspective, Vicinity, owner of shopping malls, owner of Chadstone here in Melbourne, a dividend yield of around 6%. Look, the portfolio is in really good shape, particularly entering the consumer period ahead. Effectively full, 99%, leases growing at 4 odd %. So here's an example of a part of the market that we see as attractive from an income perspective, particularly compared to the market overall, generating a dividend yield of only a little bit above 3.5% at the moment, and particularly compared to a cohort of the market that has traditionally been looked to for income, and that is the banking sector. We feel that sector's really run quite hard. We think there's some vulnerability from a valuation perspective, and hence we don't look for our income out of that sector at this point in time.
Marcus, let's talk healthcare. Last year in 2023, the sector was up 2.3%. So far this year, it's up more than 7%. What has led to the recovery? And I guess more importantly, where are you finding value in the space?
Yeah, it's a great question, Chris. And I think, in fact, if we include this reporting season as well, so up until the end of August, the healthcare sector's now put on about 9%, and that compares to the market overall at about 9%. This, however, hides the big story of healthcare, and that is underneath the sector, there are actually some really divergent trends that are either acting as head or tailwinds to particular parts of healthcare. Moving forward, we see the opportunity in really the healthcare device part of the market. ResMed wouldn't be an example in that space, where they're really doing a great job to grow the end market, grow demand, and have some really attractive margins when doing that. Ansell is an example from a healthcare supply perspective as well in the protective equipment space, and we're seeing that company continue to benefit from normalising end market conditions. The part of healthcare that we continue to be cautious about and avoid at this point is really around parts of the space that continue to have sticky input costs and regulated pricing. So Sonic would be an example of that in pathology, Ramsay on the private hospital side.
Michael, I'll come to you now. Last time we spoke, you were talking about 2024 being the year of the small cap. How is that playing out and sort of where are we now?
Small companies have continued to underperform during 2024, but the outlook is positive. So if you look at small companies, they've actually underperformed by 5% during calendar year 2024, and the cumulative impact since the start of 2022 is now 30%. So you've seen very significant underperformance from small companies. Going forward though, there are a number of factors that support a more positive outlook. The starting point is obviously depressed with them having underperformed by that 30%. We expect interest rate reductions to be a positive catalyst for small companies going forward, and we've seen example that has played out in the US, and that's consistent with history. We expect earnings growth to re-accelerate after 2 years of declines, so that'll be supportive of our performance. We expect those earnings to grow at over 10% per annum, and also valuation metrics are back to attractive levels. On a 1 year forward PE basis, small companies are trading on 16 times, but that's on depressed earnings, so we've got valuation support as well.
Michael, you touched on some of the elements there, but what really justifies that accelerating earnings growth outlook for small caps?
We expect small caps to see earnings growth accelerate to over 10% per annum over those next 2 financial years. A number of factors support that. Firstly, the depressed starting point. You've had 2 years of earnings declines. We also expect the Australian economy will re-accelerate, in particular as we move into 2025, which will be a supportive factor. We're seeing increased capacity in the labour market, which is allowing more small companies to hire and in particular grow market share, and that's been constrained materially over the last 2 years. We expect margins to expand, prices in general are holding, and you're seeing cost inflation moderate. We expect interest rates to start reducing, you'll have lower interest costs and stimulate the more cyclical parts of the economy, and across the small companies market, balance sheets are in a really strong position. So we're seeing increased capital investment back into businesses to support earnings growth.
Joel, I'll come to you now talking about micro caps. Let's talk about the impact of potentially lower interest rates. How does it impact your opportunity set and perhaps your decision making as well?
Yeah, it's really interesting. With what Michael just said, microcaps is the poor cousin to small caps, right? So everything that exists in terms of underperformance, lower valuation starting point, all of those things is on full display. And we've been in a risk-off environment, right? So liquidity's been important. People haven't wanting to come down into the more perceived risky part of the market. But underneath that, there are companies that are genuinely every reporting season getting better, getting stronger, growing their share, doing all of those good things. I see interest rate cuts as that catalyst point for people to say, you know what, it is risk on again. I can start to look more broadly across the portfolio. This company's growing fantastically well. It's taking share. It's got a long trajectory ahead of it. Balance sheet's great, and it's trading really cheaply. So I think that that's going to be a really important catalyst for people and liquidity coming back down into the microcap space. And we think the portfolio is really well positioned to capture some of those opportunities as people start to look further down the market cap spectrum.
Joel, you've just sold the opportunity in micro caps very well. Can you give us a couple of companies that you really like at the moment and you have high conviction on?
Yeah, so maybe the first one, Saunders International. We probably haven't heard of it. 100 million market cap, sub 10 time PE, 5% fully franked dividend. These are very, very good numbers. They're a tank building business, so think big fuel storage and things like that. But over time, they've become multidisciplinary, so they can do more for their clients. End markets, defence, water, energy, resources, big tailwinds here in terms of spend. This stock reminds me a lot of Southern Cross Electrical, which is a stock that's performed really well, and I'm sure a lot of your viewers are aware of. We think that this looks really similar to that, and over the next 6 or 12 months, we'd expect it to kind of come onto the radar a little bit more as it continues to deliver those really strong results. Another one that's probably worth pointing out is Eureka Group, another very small company, provides affordable housing to older people. But what's interesting about this business, we really like the model. The fact that Simon Owen has come and joined as managing director. He took Ingenia from a microcap to a general big small company, of which we participated in that journey. We think it's really interesting to bring a guy like that with that kind of experience into this part of the market, which just offers a lot of opportunity. So we think that that's another really interesting idea over the next 12, 18 months.
A couple of compelling opportunities there. Thanks, Joel. Gents, now that we've talked about the opportunities in your respective cap spaces, we want to talk about some cross-cap opportunities. Got to make sure I say that right. The first one is materials. I spoke to your head of equities, Dion Hirschon, back in April, and the house view at the time was that resources ex iron ore looked compelling, and Dion said, I'll make sure I get this quote right, there are a lot of resources where the supply side looks completely challenged. So the question is, how has that view evolved, gents? And is there a commodity that you all particularly like? Marcus, I'll come to you first.
Yeah, no, thanks, Chris. So maybe building on that comment back in April. So, look, copper would be a commodity that comes to mind that would still be quite constructive on, and really, you know, supported by the fundamentals in the outlook. We still like the demand medium to long term, supported by global growth, electrification. And on the supply side, building on the comment made there, it's really challenged, and that part of the picture for the commodity remains the same today. So it's harder to bring on more supply, and also the grade is also less than what we've historically got out of copper mines. That sets up quite a strong outlook for the commodity. Within the large cap space, I might talk to a number of ways that we're playing that from a diversified mining perspective, and then perhaps some of the pure players others will be able to address specifically. On the large cap side, we really get exposure to copper as a commodity through BHP. It's about 25% of the earnings at the moment, and actually through Evolution Mining as well. It's about 30% of group earnings there. Interestingly, from the BHP result that we've just recently seen, it's quite clear that copper has a big part of the future of this company. In fact, if you actually go through the presentation, you'll see the word copper referenced in excess of 5 times more than iron ore during the deck. So I think that's a pretty good indication. So the world's largest copper producer and a strong pipeline of growth. Evolution, you know, historically known as a gold company, it's the majority of its earnings. But we were quite happy with the Evolution result, and look, we do see that 30% exposure to copper as a way of getting exposure to the commodity.
Gents, I think one of the misconceptions is that copper is hard to access on the ASX. Marcus, you've just talked about the fact that it is within a diversified company in terms of BHP. Michael, I'll come to you now. Is there any specific copper companies in the small cap space that you like? And then is there anything that you wanted to comment about copper more broadly?
In the small companies market, our preferred copper exposure is Sandfire, completely copper exposed business. You've seen strong production growth for Sandfire, so they've had production increase by 50% on a copper equivalent basis, so they've moved to being a 2-mine company. We believe there's further upside in the long term from increasing production rates and also extending the mine lives of those 2 mines. They're also very well positioned from a cost perspective. They're a low cost producer, so they're highly sustainable at all copper prices. And if you look at the outlook over the next 3 to 4 years, we expect very high levels of free cash flow, and the debt levels will come down quite quickly as well, and they'll move to a strong balance sheet. So our preferred exposure is Sandfire.
Joel, what about you in the micro cap space in terms of copper?
Well, we always like to hedge our bets, Chris. So we like AIC Mines. So that's Aaron Colleran, ex-Evolution. He was very early in the journey, and I think that he's looking at copper as the future and looking to try and build something in terms of the journey that they went on as well. So they've got a very old, deep mine, generating good cash and things, but some growth projects that they're putting together. So production growth over the next couple of years and providing really good exposure and rate management very highly. Firefly Metals in Canada, it's the ex-Bellevue team, and they've identified a copper asset, some fantastic drilling results, and that project continues to move forward. And I don't think people can underestimate the picks and shovels approach. And we would point to Lycopodium, which is an engineering company. They're doing some early work engineering on 2 of Barrick's largest copper projects globally. And if these projects get sanctioned and Lycopodium are part of that process, then they will be very, very busy for a significant period of time as they, help address some of these supply issues if these projects actually come into fruition.
Gents, once again, some great opportunities there in the copper space. To round things out today, I wanted to talk about this concept of innovation. So whether it's AI adoption, finding new, more efficient ways to do things, designing new products, innovation is critically important for driving value creation. So I just wanted to ask each of you, within your respective cap spaces, is there a company that you think is doing incredibly innovative things at the moment? Joel, I might come back to you and start over this end.
Well, I think that's a great question because that's what microcap investing is all about. If you're a small company doing exactly the same thing as everyone else, you're not going to scale, you're not going to win. So that is the core of what we're trying to look for. Probably an interesting example for us is a company called Botanics. So they've just had a FDA approved treatment for hyperhidrosis, people that suffer from excessive sweating. It's a reasonable amount of people that suffer from this issue, and it's a really novel treatment. It has its approval and it's ready to sell. The innovative piece is management know what they're doing. They've bought and sold a lot of assets in this industry, and where a lot of Australian companies go particularly wrong is in this commercialisation phase. So actually turning the product into revenues. We really like in the early stage in terms of the paths to market they're taking and the approach they're doing. We think it's pretty innovative, and over the next 6 months hopefully we'll see some good examples of traction being seen, but that's the one we'd say looks really innovative to us.
Michael, what about you in the small cap space?
Imdex is a company I'd call out as being highly innovative. They're a global leader. They've got technology products and consumable products servicing the mining industry. They've got a technology portfolio that's highly attractive, and we believe that'll support significant market share growth going forward. So attracting new customers, and also there's a big opportunity to sell more of this product set to existing customers, so a greater share of wallet. They've got the additional benefit of having cyclical earnings upside going forward from exploration activity recovering. It's a capital light business that they'll move to being net cash in the next 12 months, and valuation for a company that's got quite a few technology assets looks highly attractive, and earnings are cyclically depressed.
Marcus, last but not least, I think oftentimes people think that at the top end of town less innovation occurs, but what's a stock that proves that that's not the case?
I'm going to give an example here that might surprise some, because it's an example in an industry that historically probably hasn't had a great amount of innovation. So the industry is plumbing supplies, and the company is Reliance. Right. What we've seen Reliance do is just complete in the US, their biggest market, rolling out a new product called SharkBite Max across US big box retail stores. So this is a push to connect fitting that typically connects pipes sitting behind your wall in your bathroom or kitchen, typically sells for $5 to $10. But what this part does, and the feedback we're getting from plumbers, is that it's stronger than the alternate, so it lasts for longer. And then it's faster to install. So there's a clear value proposition here. We're hearing this back from the plumbers, we're hearing this from the homeowners. It's a great example of product development, innovation that's now created differentiation. We're starting to see that come through the top line for Alliance.
Gentlemen, thank you so much for taking Livewire readers and viewers through reporting season and for sharing some very compelling stock opportunities. We really appreciate it.
Thank you.
Cheers.
If you enjoyed that interview as much as I did, make sure to give it a like and don't forget to follow our YouTube channel because we're adding lots of great content every single week.